Live from New York, where business never sleeps, this is Squawk Box.
All right, coming up, energy prices. Under pressure this morning, we're going to talk to one of Canada's largest independent oil and gas companies. But first, as we head to break, check out the dollar this morning.
Welcome back, everybody. It has been a tough environment for energy companies, with crude prices tumbling almost 20% this year, and that comes on top of even bigger declines from before that. Our next guest runs one of Canada's largest independent oil and gas companies, with U.S. operations in the Bakken and Marcellus shales. The company reporting a mixed quarter last week, but announcing that it is increasing its 2015 production guidance, driven by growth in the Bakken shale. Ian Dundas is the president and CEO of Enerplus. And Ian, thanks for coming in today.
Thank you.
The big news last week, at least in Canada, was that the Keystone Pipeline has been shut down by the Obama administration. What does that mean for your business in particular, and what does this mean for the future of Canadian production?
You know, I don't think this was a particular news for people who are watching this very carefully. I think this is well telegraphed by the administration for quite a while now. And so I think industry, in some respects, has moved on. You know, Canadian oil is moving to U.S. markets. Rail has been a really big part of that. And so I think people have been very focused on alternative market access for quite a few years now as this drama has played out.
Do you think that there will eventually be another pipeline that doesn't cut across the United States? Do you think there'll be more rail production that's brought in? And what does it do just in terms of limiting the amount that you could take out of the ground and get put somewhere else? Yeah,
I think Canadian oil is going to move to market. It's going to move to the U.S. It's going to move overseas. It's going to find a way. Rail is going to be a part of that. I think pipeline may well be a part of that. I think the only real issue that's going to come out of this is just going to be potentially less efficient than pipeline access.
In terms of raising your production for the next year, what is that based on? What's happening that you see right now, and why do you think you can do that?
Yeah, so we, like I think a lot of oil companies, are living within this tough market that you described, and so that means we are sort of rationing our capital, and we are growing less than we otherwise would be. For those who don't know our company, we've got a very big project in the North Dakota shale in the Bakken. We're sitting in the sweet spot of the play, and so we sort of continue to have pretty strong well results, which has been a really key driver of growth for us.
When is it profitable for those well sites in those areas? If oil falls below $40, is it profitable for you? And what's the difference when oil is back at $80?
Yeah, it's evolving, clearly. I think something that's critical in thinking about U.S. supply and growth is understanding that these shale plays are not all created equal. In the Bakken produces about 1.2 million barrels of oil a day. You know, we'd calculate about 10% of the acreage is really core and tier one. So for us, in that core area, we break even about $40 oil. So, you know, now the strip points to 50-ish. It's not as exciting as it once was. But our break-evens...
43 this morning, 43 and change this morning.
43 this morning. We've got some good hedges, which helps out a little bit. But it's a really important dynamic that's played out, where we've seen this amazing growth in the U.S. Oil production, and so much of it's been areas that need prices that have been higher than we're dealing with right now.
Yeah, when you say that it's 10%, it's $40 as break-even. Does that mean the other 90% you need it to be 45, 50, or?
Yeah, we're quite fortunate. When we've been in the U.S., we're, I guess, a Canadian-based company. Most of our production's in the U.S. We've been in the U.S. since '05. And when we set up our play, we tried to get in a sweet spot, and that ended up working out for us. So when we look at our acreage, we think all of our wells are in areas that break even at under that $50 level. That wouldn't be a sort of a normal dynamic when you look at most of these plays.
The IEA just came out and is now saying that they don't expect oil to get back to $80 a barrel until the year 2020.
Yeah.
It's a little surprising. Does that fit with your forecast for where oil prices are headed?
Yeah, so it's complicated making this call clearly. You know, we're planning for a lower scenario. We've cut our capital. We're moderating our growth. We actually cut our dividend as well to prepare for a $50 world. I would say there are some pretty powerful forces out there that seem to be setting the seeds for a bit of recovery. You know, demand growth is strong, and industry has cut hundreds of billions of dollars of capital out of projects. I mean, that is going to impact supply. So, you know, can we stay in that lower scenario for a long time? Maybe, but I think there's some pretty powerful forces that could push it up.
The cuts that you've already made assume a $50 oil market for how long?
Next year.
For the next year?
Yeah, next year.
What happens if we stay in the $43 to $45 to $48 range for the next year?
Yeah, so you know, we're gonna remain, I'd say, nimble in connection with that. We've rolled out a capital program next year that's 30% lower than this year, which was 30% lower than last year.
Right.
We have an ability to bring that down a little bit. I think the thing that has been really interesting to watch and being on the front lines of this is how fast costs have responded.
Sure.
You know, we talked earlier about this break-even supply cost. The U.S. needed $60, $70, $80 oil as recently as a year ago for many of these shale plays to work, and now they're starting to work. So I think if we stay in this $43 world, you know, we are going to see cost response, and we're going to see a force of innovation that's playing out here as well that's impacting.
We have an oil analyst, John Kilduff, who joins us pretty frequently, and he's been pretty right on about why prices have stayed lower for longer and thinking that they would be in this area. One of his points is that it's a lot easier these days to turn wells back on very quickly if oil prices start to pick up north of $50. He thinks that will continue to keep pressure or keep a lid on things for quite some time to come. Would you agree with that?
It has been one of the variables. As price rolled off really, really quickly, people started to stop completing wells.
Right.
You know, so wells have been producing. You typically keep producing, but it's that extra little bit of spend to bring a well on to complete it. That phenomena is playing itself out, though. I think that's a 2015, maybe into 16 phenomena. We were an example of that. A year ago, we stopped completion activity in North Dakota for the biggest project in our company. We drilled wells and we sort of stopped that partway through the project. That's a pretty unique phenomena for companies to do that. But as costs have come down and oil price came up a little bit, you know, we were able to hedge more and started to complete those wells. There's not as much of that going on any longer.
All right, Ian, thank you very much for joining us today.
Yeah, thank you. Appreciate your time.
Okay, coming up when we return, the CEO